Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Okay, let's dive right into this explainer. Today, we're breaking down IRS Notice 2026-49. Now, if you're a CPA, a plan administrator, or an IRA custodian, you already know that the retirement rollover process has been a massive thorn in the side of this industry for decades, right? But things are changing, and they're changing fast. We're talking about fundamentally shifting how we handle retirement rollovers under the Secured 2.0 Act. For years, the friction in moving retirement assets has cost investors billions of dollars in lost market exposure. And for CPAs, it's created absolute nightmare scenarios trying to clean up messy tax reporting during busy season. Well, we're finally moving away from a world of lost paper checks, frustrating participant confusion, and dangerous tax traps. We're entering an era of encrypted, API-driven, plan-to-plan communication. So let's get right to it.
Here's our roadmap for today. First, we'll cover the retirement rollover problem. Second, direct versus indirect rollovers. Third, the Secure 2.0 standardization mandate. Fourth, the new 5-step procedure. And finally, planning points for CPAs. We're going to guide you through the legislative background, the critical tax code distinctions, the mechanics of these new standardized procedures, and most importantly, the actionable takeaways your firm needs to start implementing right now.
Section 1. The retirement rollover problem. The burden of archaic paper processes. We'll start by looking at the deep-seated inefficiencies and compliance risks in the current rollover environment. For years, participants moving their retirement money between a 401k and an IRA have essentially been forced to act as the middleman. They get a check, they hold on to it, and they're tasked with getting it to the new institution. It's a process fraught with delays and immense risk. The Government Accountability Office actually pointed this out over a decade ago in their 2013 report. The frustrating lack of uniformity across different retirement plans leaves participants acting as intermediaries with easily lost paper checks. And this lack of uniformity is incredibly dangerous from an operational standpoint. Think about it. Plan administrators are currently forced to process hundreds of variations of distribution forms. That leads to inevitable human error, compliance violations, and missing funds. When a participant loses a check or simply forgets to deposit it, that money just sits uninvested, missing out on crucial compound interest. Furthermore, administrators are eventually left dealing with the massive headache of uncashed checks and complex state escheatment laws. As the GAO stated way back then, this entire system just appears completely archaic in our modern electronic world.
But here's the kicker. Despite all of us knowing exactly how outdated paper checks are, recent data from a 2024 GAO report reveals a pretty shocking reality. Nearly 1/3 of participants still receive paper checks when completing a rollover, 33%. This puts the onus and the massive tax risk entirely on the individual taxpayer. For a CPA, this is a recurring tax season nightmare. We've all been there. A client walks into your office in March with a 1099-R showing a massive taxable distribution, all because a paper check sat in their kitchen drawer for too long, missing the critical rollover windows. The risk of human error is just way too high. And that leads perfectly into why the IRS is finally stepping in to fix the structural mechanics of these transfers.
Section 2. Direct versus indirect rollovers. Navigating the code. Let's look at the technical distinctions here.
As tax professionals, you know that how a rollover is executed completely changes the tax consequences and the reporting requirements for your client. The most critical technical distinction we deal with here is the stark contrast between Section 401A31 direct transfers and Section 402C3 indirect transfers. When an indirect rollover occurs, meaning the funds are paid directly to the participant, a very stressful clock starts ticking. They face a strict 60-day deadline to redeposit those funds into an eligible retirement plan. But here is the real danger, the 20% mandatory withholding trap on indirect rollovers from qualified plans. Let's walk through what this actually looks like for a client, just to put it in perspective. Imagine your client leaves their job and wants to roll over a $100,000 401k balance to an IRA. If they opt for an indirect rollover, the plan administrator is legally required to withhold 20% for federal taxes. So the IRS gets $20,000 and your client receives a check for $80,000. However, to complete a fully tax-free rollover, the tax code requires the client to deposit the entire original $100,000 into the new IRA within 60 days. This means your client has to magically find $20,000 in cash lying around out of their own pocket just to make up for the withholding and complete the rollover. If they can't come up with that $20,000 in 60 days, that withheld amount becomes a permanent taxable distribution. And if they're under age 59 and a half, they're hit with an additional 10% early withdrawal penalty right on top of the income tax. It is a catastrophic, wealth-destroying trap that trips up countless taxpayers every single year. Now, a direct trustee-to-trustee transfer avoids all of this entirely. There's no 60-day ticking clock and absolutely zero withholding headaches.
Section 3. Secure 2.0. Standardization Mandate, a framework for the future. So how do we fix this?
To solve these exact problems and push the industry away from those disastrous indirect rollover traps, Congress realized they had to act. The directive embedded in Section 324 of the Secure 2.0 Act was abundantly clear. The Treasury must develop sample forms and protocols to simplify, standardize, facilitate, and expedite rollovers to eligible retirement plans. IRS Notice 2026-49 is the direct answer to this mandate. It proposes a standardized framework that strongly encourages encrypted data transfers and demands coordination directly between the receiving plan and the distributing plan. That completely bypasses the participant's mailbox. More importantly, notice the pressure regarding processing timelines. The IRS is signaling a rapid shift. They want these standardized protocols adopted swiftly to eliminate the weeks of limbo clients currently experience. Plan administrators need to start updating their compliance systems immediately because the runway for these implementation timelines is getting shorter as we approach the effective dates of these Secure 2.0 provisions.
To make this plan-to-plan communication secure, you absolutely need to understand the RIN, or Rollover Identification Number. The RIN is essentially the encrypted anchor of this entire new API-driven process. It's a unique 20-digit alphanumeric code generated by the receiving plan right at the start of the rollover. Think about the cybersecurity implications here. Instead of forcing clients to write their social security numbers on a piece of paper, or administrators passing full names and sensitive tax IDs back and forth over insecure channels, the plans just use the tokenized RIN to securely track the rollover. This completely eliminates the liability of transmitting unencrypted social security numbers, which is a massive, long overdue victory for compliance officers and data security teams across the financial sector. Personal identifying information remains locked down while the funds move seamlessly.
Section 4. The new 5-step procedure, mastering forms 1 through 4. Let's look at the actual mechanics of the newly proposed 5-step procedure.
Consider this your new cheat sheet for the rollover lifecycle. The IRS has drafted 4 specific sample forms to facilitate this entirely new workflow. Form 1 is the participant's authorization. Form 2 is the receiving plan initiating the request. Form 3 is the distributing plan certifying the funds are eligible. And Form 4 is the receiving plan officially accepting the transfer. The psychological and operational shift here is profound. After Form 1 is submitted, the participant is completely removed from the workflow. They don't touch the money, they don't handle the checks. The burden shifts entirely to direct institutional plan-to-plan communication. This effectively protects the client from themselves and entirely bypasses that 60-day tax trap we discussed earlier. Okay, let's dive into how this flows in practice. Step 1, it starts with the participant securely submitting Form 1 to the receiving plan. Note that not the distributing plan, the receiving plan. That's a big paradigm shift. The participant basically authorizes the receiving plan to act on their behalf. In Step 2, processing timelines become critical. Once the receiving plan gets Form 1, they're expected to act efficiently. They immediately generate that vital RIN, attach it to the authorization, and fire off Form 2 directly to the distributing plan, outlining exactly how they can securely communicate and accept funds. The expectation here is that this happens without delay, eliminating the agonizing weeks-long waiting period where clients are currently left wondering where their life savings went.
Now, Steps 3 and 4 act as an incredibly secure electronic handshake. In Step 3, the distributing plan independently verifies the participant's data. They ensure spousal consent is documented if it's required under ERISA rules, they validate that the plan is tax qualified, and they certify the funds are actually eligible for rollover. Then, they send Form 3 back to the receiving institution. In Step 4, the receiving plan confirms they can accept the specific transfer method and sends the form for acceptance. This rigorous plan-to-plan handshake is absolutely vital because it indemnifies the CPA and protects the institutions from compliance failures before a single dollar moves. Only after this verification does Step 5 occur, triggering the actual electronic movement of funds. No more blindly mailing checks and crossing your fingers.
Section 5. Planning points for CPAs. Over the horizon. Let's talk about what this means for your firm.
While these sample forms are currently optional, the IRS Notice includes a section on future guidance under consideration that signals a massive regulatory shift you need to prepare for. The most crucial takeaway here is that the IRS is strongly considering making these electronic, participant-free transfers mandatory.
They're looking at explicitly stripping away the existing regulation that allows paper checks to be mailed to participants at all. They want to mandate electronic transfers, or at the absolute minimum, require that any paper checks be mailed directly to the receiving plan, never touching the participants' hands. To sweeten the deal and encourage adoption, they're proposing powerful new safe harbors. If you use these standardized forms, you can legally rely on the other plan's certifications to guarantee zero withholding and valid tax qualification. That completely removes the audit risk for your firm. Furthermore, they plan to ban impermissible roadblocks, most notably forcing participants to obtain a medallion signature guarantee. We all know how much clients absolutely despise having to track down a bank branch manager just to get a special stamp to move their own retirement money. Banning this roadblock is a massive quality of life improvement. The operational paradigm is shifting, and your administrative procedures must evolve quickly to adapt.
So, we are rapidly moving from a world of lost checks and 60-day tax traps to a seamless future of secure API-driven transfers. As you prepare your clients, plan sponsors, and administrators for this monumental shift, you really have to look closely at your internal systems. The IRS is actively pushing the integration of these standardized procedures into electronic clearinghouses. So the question you must ask yourself is this: how quickly can your firm adopt encrypted API infrastructure to secure these safe harbors in the new era of automated rollovers? The guidance is clear, the Secure 2.0 mandate is set, and the time to upgrade your technological processes is right.